I want you to begin with one question because questions are how you slow the mind down before emotion takes over. If you had the chance to buy a quantum stock in 2023 when it was trading for less than $1, would you have done it? Most people would say yes now. That is the easy answer after the fact. If that stock later rose more than 2,000%, almost everyone would look backward and say, of course I would have bought it. Of course I would have understood the opportunity. Of course I would have been rational enough to take the risk when the price was low and the crowd was not yet paying attention. But markets do not test you after the result is obvious. Markets test you when the facts are incomplete, when the story is uncomfortable, when the company looks too early, when the balance sheet is fragile, when the technology sounds strange, and when everyone around you is still calling the opportunity speculative. That is why this example matters. A small quantum stock that was trading under $1 in 2023 later became the kind of outcome that investors dream about. $10,000 placed at that moment would have become more than $200,000. That is not a normal return. That is not something you can build a responsible system around by expecting it to happen repeatedly. But the receipt teaches something more important than the return. It teaches the value of being prepared before the crowd becomes excited. There is a phrase I like for this. It is the woodshed signal. Think of a musician who walks on stage and plays beautifully. The performance looks sudden to the audience, but it is not sudden. It is the result of years in the woodshed, practicing when nobody was watching, building skill when there was no applause, understanding the instrument before the performance ever happened. Investing works the same way. Anyone can say quantum computing is exciting in 2026, after the headlines are loud, after NVIDIA has made announcements, after public companies have moved, after the crowd has started to chase the theme. That is not preparation, that is reaction. The real signal is what you were studying when nobody cared. The real signal is whether you were doing the work when the price was low, the sector was ignored, and the uncertainty was still large enough to scare away ordinary investors. That is the lesson I want you to hold in your mind. Not that every quantum stock will go up 2,000%. Not that you should chase what already moved. The lesson is that great opportunities usually begin as uncomfortable observations before they become obvious narratives. And when a theme moves from ignored to accepted, the entire game changes. That is what is happening in quantum computing. Now, a few years ago, the publicly investable quantum universe was very small. There were only a handful of pure play companies. If you wanted exposure, you had to make a very narrow bet on a very immature sector today. That is changing 6 months ago. There were roughly 4 publicly traded pure quantum plays. Now there are more. There are additional names that have recently entered the market. There are more in the IPO pipeline. The number of investable approaches is expanding. And for the first time, all 4 major quantum architectures are becoming available to public investors. That matters more than people think. Because early in a technology cycle, the mistake most people make is believing they know which approach will win. They pick one company, they pick one architecture, they pick one story, then they attach their ego to it. That is not how I think about emerging systems. When a new technology is early, the range of outcomes is wide. The future is not a single line, it is a probability distribution. Some approaches will scale, some will fail. Some will be acquired, some will change direction, some will become tools for a specific niche instead of becoming the whole platform. So the right question is not simply, which stock is the next 10 bagger? That is an emotional question. The better question is, what is the structure of the field? Where are the architectures different? Which companies have commercial traction? Which companies are still science projects? And how can I build exposure without letting excitement override risk control? That is the difference between gambling and operating with principles. Before we go through the names, I want to give you one decision rule that is useful in any uncertain environment. Mathematicians sometimes talk about the 37% rule. The basic idea is that before committing to a major decision, you spend the early part of the process observing. You learn what good looks like. You build a baseline. You do not marry the first thing that looks interesting. You gather enough information so that when something truly exceptional appears, you can recognize it. This is important in quantum investing because the space is moving quickly and the emotional pressure is rising. If you skip the observation phase, every green chart looks like opportunity. If you build a baseline, you can tell the difference between a real signal and a headline. That is the purpose of walking through the architecture. Quantum computing is not one technology. It is a race among several ways of trying to solve a very hard problem. There are superconducting systems. There are trapped ion systems. There are neutral atom systems. There are photonic systems. They are all trying to build machines that can do certain kinds of computation in ways classical computers cannot easily match. But they are not the same. They have different engineering problems. They have different paths to scale. They have different error correction issues. They have different commercialization timelines. and each company you look at sits somewhere inside that map. The first company to understand is D-Wave. Quantum D-Wave became the poster child for what can happen when a small quantum stock moves from ignored to discovered. Its approach is superconducting annealing. That sounds technical, but the simple way to think about it is this. Their systems are designed to solve optimization problems that exist. Now, this is not only a distant dream about a perfect universal quantum computer someday, it is about problems like supply chain routing, scheduling, drug discovery work, financial risk modeling, and other tasks where the goal is to find better solutions in very large possibility spaces. That distinction matters. Many quantum companies are promising the future. D-Wave has been able to point to customers using systems today. Full year 2025 revenue was reported to be up substantially year over year. But the part that makes serious investors pay attention is what happened early in 2026. In January and February alone, D-Wave booked more in new contracts than it had produced in all of 2025 annual revenue. When a company books more in 2 months than it did in an entire year, you should not automatically buy it, but you should study it, because that type of acceleration can represent a phase change. And in markets, phase changes are where large returns can happen. There's another important point that many people miss. D-Wave acquired capability that gives it a second quantum architecture path. It is no longer only an annealing story, it now has gate, model capability as well, beginning with a small operational system and a roadmap toward more qubits over the next year and beyond. That does not remove the risk. Early roadmaps can slip, hardware can disappoint, expectations can run too far ahead of reality, but strategically, it changes the way you should think about the company. It becomes less one-dimensional. It now has more than one path through the quantum landscape. The next major name is IonQ. IonQ uses trapped ions. Instead of relying on superconducting circuits, it uses individual atoms held in place by electromagnetic fields. The appeal of trapped ion systems is precision. They are often viewed as among the most accurate ways to build quantum systems. IonQ is also one of the largest quantum pure plays by revenue and market value. That is important because public markets reward leadership narratives. In an emerging sector, the company that becomes the perceived leader can attract capital, talent, partners, and government attention. Sometimes that creates a reinforcing loop. Strength attracts more strength. IonQ's backlog has grown dramatically from where it was not long ago. Revenue has also risen sharply. The company announced a major acquisition of Skywater Technology, a trusted U.S. semiconductor foundry. If that deal closes, IonQ would control more of the manufacturing process inside the United States. That matters because quantum is not just a technology story, it is also a national security story. When a technology touches encryption, defense, computing power, and strategic infrastructure, governments do not treat it like a normal software product. They care about where it is built, who controls the supply chain, and whether the capability is domestic. So when I see a quantum company trying to own more of its U.S. manufacturing chain, I see a strategic move. It may or may not work, but the logic is clear. IonQ is trying to move from being a scientific company into being an industrial and government-aligned platform. That is a different kind of ambition. Then there is Rigetti computing. Rigetti also uses superconducting gate model technology, which places it closer to the approach pursued by some of the largest technology companies in the world. But the challenge for Rigetti is concentration risk and execution risk. A meaningful portion of its expected revenue is tied to a small number of contracts. One major order is connected to India SCDAC Research Organization for a quantum system, and another is tied to Novara QPU hardware. Delivery timelines have already shifted. This is not unusual in quantum hardware. It is difficult, it is technical, it is early, things slip. But investors must treat delays differently from ordinary software delays, because hardware timelines can affect revenue, credibility, and cash needs all at once. If you own a company like Rigetti, you are making a very specific bet. You are betting that its superconducting roadmap remains relevant, and that the company can close the gap with much larger players that have more capital and deeper research resources. That is possible. But it is not low risk. In emerging technology, a lower stock price does not always mean a better bargain. Sometimes it means the market is correctly pricing fragility. Other times it means the market is too pessimistic and the opportunity is large. Your job is not to decide based on hope. Your job is to study whether the milestones are being met, whether capital is sufficient, whether customer demand is real, and whether dilution will shrink your ownership faster than progress increases the value of the company. Then there is Quantum Computing Inc., often traded under cup. This is where I would slow down even more. The company has reported very small revenue compared with the scale of attention it has received. Its filings have included serious warnings. It has faced securities fraud lawsuits and short seller allegations regarding relationships and revenue claims. When you see that combination, you must be extremely careful. Could a very risky company still rise sharply in a hot sector? Of course, markets do that. Speculative capital can move into the highest risk names because the price is low and the dream is large. But price is not protection if the business reality is weak. The greatest danger in early stage sectors is confusing upside with quality. A stock can have enormous theoretical upside and still be a poor risk adjusted decision. That is why I would place a name like Cupped in the highest risk category. It may be interesting to monitor, but it requires a very different mindset from owning a company with real revenue, real contracts, and a clearer technological path. Now we move into the newer public entrants, and this is where the quantum field becomes more interesting because the other architectures start to appear. One of the most important new names is Infleqtion. Infleqtion uses neutral atom technology. Neutral atom systems have a scaling advantage that investors need to understand. They may be able to reach very large numbers of qubits without some of the same engineering problems that other approaches face. That does not mean they automatically win, but it does mean the architecture deserves serious study. Infleqtion also has institutional support that stands out. NVIDIA selected it for 2 different quantum programs. I do not treat every partnership announcement as meaningful. Many companies announce partnerships that sound impressive but do not create substance. But when a company is selected by NVIDIA more than once in a strategic technology area, I pay attention. The more important point is that Infleqtion has more than one revenue stream. It has quantum computing exposure, but it also has quantum sensing. The sensing side includes deployed hardware, including systems associated with NASA and the International Space Station. That matters because it means the company is not only waiting for the dream of full-scale quantum computing, it has commercial and government-facing applications today. For a newly public quantum company, revenue above $30 million and guided growth is not trivial. It does not make the company safe. It does not remove dilution risk. It does not mean the stock is cheap, but it gives investors something concrete to measure. In early technology, concreteness is valuable. You want to know whether customers are paying. You want to know whether the systems are deployed. You want to know whether the company has more than a concept. Infleqtion appears to have more than a concept. Then there is Xanadu. Xanadu brings the photonic architecture into the public market conversation. Photonic systems use photons, and one of the advantages is that they can operate at room temperature. That can be a meaningful engineering advantage because some other quantum systems require extreme cooling, which creates cost, complexity, and scaling challenges. But the most interesting part of Xanadu may not be hardware, it may be software. Xanadu created Pentalane, an open-source quantum programming framework that is widely used by quantum developers. It has large monthly downloads and strong usage growth. This matters because software platforms can become powerful even if the hardware race remains uncertain. If Pentalane works across multiple quantum architectures, then Xanadu has a layer of exposure that does not depend entirely on its own photonic hardware winning the race. That is an important strategic difference. A pure hardware company can win big if its architecture wins, but it can lose badly if another architecture becomes dominant. A software framework used across architectures has a different kind of optionality. It can benefit from the growth of the entire field. That does not make Xanadu safe. Its revenue is still early. The stock has been volatile. The market will likely overreact in both directions. But when you analyze it, you should separate the 2 cases. One case is photonic hardware. The other is developer ecosystem. They are related but not identical. A third new entrant is Horizon Quantum. Horizon builds hardware-agnostic quantum software tools. That means it is not trying to win by choosing one architecture. It is trying to become part of the middleware layer, the tools that help developers and enterprises use quantum systems regardless of which machine they ultimately run on. That can be a very attractive position in theory. In many technology cycles, the infrastructure and middleware layers can create more durable economics than the most speculative hardware layer, but theory is not enough. Investors still need to see customers, revenue growth, adoption, retention, and evidence that the tools are becoming necessary rather than merely interesting. Still, in a field where nobody knows the winning architecture, hardware, agnostic software is worth watching. Beyond computing itself, there are also quantum security names. One is CLSQ, which is focused on post-quantum encryption chips, designed to protect systems before quantum computers can break today. Encryption methods. Another is Archit, which works on quantum safe key distribution. These are very early, some are pre-revenue or close to it. They are not the kind of companies where you can casually allocate money because the theme sounds strong. But they show something important about the quantum universe. Quantum is not only about building faster computers, it is also about what those computers could disrupt. If quantum machines become powerful enough, they may change encryption. That creates risks for existing systems and opportunities for companies trying to secure the post-quantum world. The market may eventually reward that layer, or it may not. The timing is uncertain, and the revenue may take longer than hopeful investors expect. But the category belongs on the map. Then we have the IPO pipeline. Quantinuum, majority owned by Honeywell, has confidentially filed for an IPO and is targeting a very large valuation. If it comes public near that level, it could instantly become one of the largest quantum companies in the public market that would change the benchmark for the whole sector. When a large, better capitalized quantum company enters the public market, it can reprice the field. It can make some smaller names look cheap by comparison, or it can expose how speculative their valuations are. It can draw more institutional attention, but it can also raise the bar. Then there is IQM out of Finland, expected to come public through a SPAC at a meaningful valuation. There is also Pasquale out of France, targeting a public listing later. By the end of 2026, there could be 8 or more publicly traded quantum pure plays across all 4 major architectures. That has never happened before. And when a sector moves from a few isolated names to a broader investable universe, the behavior of capital changes. Specialized ETFs appear. Analysts begin covering more companies. Institutions can build baskets instead of one-off positions. Index inclusion becomes possible. Comparisons become easier. And eventually weaker players are separated from stronger ones. That is how a speculative theme becomes an industry. Now, before getting excited about the pure plays, you need to understand the infrastructure layer. This is where the probability-adjusted analysis changes. Amazon Web Services hosts several quantum hardware providers on a single cloud platform. Microsoft Azure hosts multiple providers as well. NVIDIA integrates with a large portion of the world's quantum processors through its software platform and venture investments. These companies do not need quantum to succeed. That is important. Amazon, Microsoft, and NVIDIA have enormous businesses already. They generate cash flow today. They have cloud platform, software ecosystems, AI infrastructure, and customer relationships at global scale. If quantum succeeds, they can become toll collectors. If one quantum architecture wins, they can support it. If another architecture wins, they can support that too. If multiple architectures coexist for different use cases, they can host the ecosystem. This is why, in an early technology cycle, infrastructure often deserves the largest allocation. It reduces single company risk. It reduces architecture risk. It gives you exposure to the upside without requiring you to correctly predict the precise winner. That does not mean these companies are cheap. It does not mean they cannot decline. It does not mean you should ignore valuation. But structurally, they sit in a different place than the pure plays. A pure quantum company may need quantum to work very soon. An infrastructure giant can wait. That difference matters when you think in probabilities rather than stories. So are quantum stocks still at good entry points today? The answer is not yes or no. The answer is maybe, depending on what you are buying, why you are buying it, how much you are risking, and whether your decision is calibrated or emotional. This is where the 37% rule comes back. The first phase is looking. You watch, you learn, you build your baseline, you understand the architectures, you separate revenue from promise, you separate contracts from press releases, you separate hardware roadmaps from real commercial use, you separate infrastructure from pure plays, you separate speculative security names from companies with operating traction. Once you have done that, you are no longer just reacting to headlines. You can begin to judge signals. If a company announces a contract, you know whether it is large relative to its revenue. If a company raises capital, you know whether dilution is necessary or excessive. If a company claims a technical breakthrough, you know whether it actually changes commercialization. If a stock jumps 30% in a day, you know whether the move is based on a real change in probabilities or just sector excitement. That is what observation gives you. It turns emotional noise into analyzable information. There is also a psychological point that is very important right now. 6 months ago, the fear around quantum was simple. People were afraid the technology would not work. They were afraid the science would take too long. They were afraid companies would burn cash before commercial demand arrived. They were afraid the sector was too early. Now, for many investors, the fear has flipped. It is no longer only what if quantum does not work. It has become what if quantum does work and I am not in it. That is a dangerous transition. The companies may not have changed enough to justify the emotional shift. The risks may still be large. The cash burn may still be real, the dilution may still be coming, but the fear has moved from loss avoidance to missing out. When you feel that inside yourself, stop. That feeling is not a buy signal. It is not a sell signal. It is a pause signal. The same fear that stops investors from buying near the bottom often pushes them to buy near the top. It is still fear. It has simply changed direction. Principled investing requires recognizing the emotion before it drives the decision. There is one more issue that must be stated plainly. Nearly every early-stage quantum company is burning cash. Many will issue shares to survive. That means that even if the company progresses, your ownership can be diluted along the way. This is one of the most misunderstood risks in speculative technology. People look at the potential market and say, if this company captures even a small share, the stock could be worth many times more. But they forget to ask how many shares will exist by the time that future arrives. If a company must repeatedly raise capital, your slice of the pie can shrink while the pie is being built. Sometimes that is acceptable if the capital funds real progress and the valuation grows much faster than dilution. Shareholders can still win. But sometimes dilution simply keeps the dream alive without increasing the odds of success enough to justify the cost. You have to watch that carefully. Cash burn is not automatically bad in a frontier technology company, but cash burn without clear milestones is dangerous. Now let us think about allocation. If I were building exposure to quantum today, I would not treat it as one bucket. I would think about it in layers. The anchor layer would be infrastructure. If I had $100 allocated specifically to quantum-related exposure, I would place about half of it in the infrastructure layer. That means companies like Amazon, Microsoft, NVIDIA, and other platforms that generate cash today and can benefit from quantum no matter which architecture wins. This is not the most exciting layer. It will not give you the same upside as a tiny pure play that suddenly becomes the market's favorite name, but it has a better probability profile. It allows you to participate in the theme without needing to be exactly right about the scientific winner. The next layer would be the pure play builders. This is where I would put a meaningful but smaller amount. These are companies like D-Wave, IonQ, Rigetti, Infleqtion, Xanadu, Horizon, and others in the expanding public universe. This is where the potential outsized returns live. This is also where the losses can be severe. The reason I would consider allocating more here than I might have 6 months earlier is that the universe has broadened and the sector has corrected in places. More choices can create better portfolio construction, better entry points can improve expected value, but neither of those removes the fundamental uncertainty. Pure plays should be sized so that you can survive being wrong. That is a principle many investors ignore. If an asset can go up 10 times, people focus only on the 10 times. They forget that the same asset may fall 70%, 80%, or more if expectations break. The sizing must reflect that reality. The final layer would be what I would call the penny dreamers. These are the very early, very speculative names where a single breakthrough could multiply the stock, but where failure is also a realistic outcome. This could include early photonic and quantum security names, post-quantum encryption companies, and microcap ideas that sit far out on the risk curve. This layer should be small. It exists because optionality has value, but optionality is not the same as a core holding. The purpose of this layer is to create asymmetric exposure, not to carry the portfolio. When investors put too much into the dream layer, they stop being investors and become lottery buyers. That is not a system, that is hope. If you do not want to choose individual names, there are quantum-focused ETFs. Some have been around longer. Several newer ones have appeared. A basket can reduce single-name risk, but it does not eliminate sector risk. If the whole quantum theme becomes overpriced or disappoints, the basket can fall too. An ETF can be useful, but you still need to understand what it owns. Some ETFs may hold more infrastructure companies, others may hold more pure plays, others may include adjacent semiconductor or cybersecurity names. The label quantum does not tell you enough. You must look under the hood. That is true in every market. It is especially true in emerging technology. So where does this leave us? It leaves us with a field that is much more investable than it was a few years ago, but still very early. It leaves us with 4 architectures now available in public markets. It leaves us with established pure plays showing revenue and backlog growth. It leaves us with newer entrants that bring neutral atom, photonic, and software layers into the conversation. It leaves us with IPOs that could expand the universe further. It leaves us with infrastructure giants that may collect tolls regardless of who wins, and it leaves us with investors facing the same psychological test that appears in every technological boom. Can you be interested without being reckless? Can you be early without being blind? Can you be patient without missing the move? Can you size the risk so that excitement does not become ruin? That is the real question. Quantum computing may become one of the most important technologies of the next decade. It may change optimization, chemistry, logistics, encryption, materials science, and computing itself. But even when a technology is real, not every stock is a winner. The internet was real. In 1999, many internet stocks still disappeared. Artificial intelligence is real. Some AI stocks will still disappoint. Quantum may be real. Some quantum stocks will still destroy capital. That is why the framework matters more than the excitement. Do not ask only, can this go up? Ask what has to happen for this to go up. How likely is that? How much capital will the company need before it happens? How much of the upside will dilution take? And what position size lets me participate without being emotionally captured? That is how I would approach it. I would not chase blindly. I would not ignore it either. I would study the architecture. I would study the revenue. I would study the backlog. I would study the customers. I would study the balance sheet. I would study the cash burn. I would study the platforms. Then I would build a position only in a way that fits the uncertainty. The biggest opportunities usually do not look safe at the beginning. But the best investors do not confuse unsafe with attractive. They separate uncertainty from risk. They look for situations where the payoff is large enough, the exposure is sized correctly, and the probabilities are improving. That is what the under $1 quantum example teaches. It does not teach that every small quantum stock should be bought. It teaches that preparation matters. The investor who had done the work in 2023 could see something others could not. The investor who only arrives after the move is now fighting a different battle. That battle is not only about the company, it is about their own psychology. Because once the return has already happened, the mind wants to believe there must be another one immediately. Sometimes there is. Often there is not. The right move is not to chase the past. The right move is to build the next baseline before the next true signal appears. That is what I would do now. I would watch, I would measure, I would compare, I would let the sector show me which companies are moving from promise to proof, and when something beats the baseline, not because of a headline, but because the underlying probability changed, then I would act. That is the difference between being early and being emotional. And in a sector like quantum, that difference may determine whether you build wealth or become liquidity for someone else.